So today we are going to be treating capital asset pricing model. So like I said, it's not a new name to you. Um, from the beginning of our class to date, we'll be talking about capital asset pricing model. But one thing you need to understand is that as far as ICANN exam is concerned, capping is one of the most frequent topic that is being tested on a regular basis. So, especially as it has to do with calculating alpha in recent time. So, when we had cost of capital, we talked about methods of computing cost of equity, which we talked about the dividend valuation model, capital asset pricing model, and then Miller and Modigliani formula. And I said that the capping is a topic on its own, that when we get there, we are going to discuss it extensively. Not only that, even when we had the project-specific cost of capital, there is no way you are going to calculate specific WACC without calculating cost of equity using capping. So virtually, you have already been exposed on how to calculate cost of equity using capping. However, the other part of capping, you have not been, you don't know, you have not been taught, and that's the essence of this class. Therefore, what do you understand by capping? The capital asset pricing model is a model designed principally to establish the relationship between expected return and then the systematic risk of a given asset, especially shares or stocks. Basically, there are three main uses of capping. Capping can be used, okay, to price risky assets. Risky assets is, stocks or shares are considered to be the most risky assets. Then two, capping can be used to determine expected return of an asset. Then three, it can be used to compute cost of capital. Those are the three main uses of capital asset pricing model. I said the first one is to price risky assets. Two, to determine expected return of an asset. Then three, to compute our cost of capital. As far as capping is concerned, it is a model that asserts that the expected return of assets will vary only by their systematic risk as measured by the beta. For the online student, we have not talked about portfolio. We have not done portfolio. So beta may be strange to you, but we have, for the physical students, we have done that. We have done portfolio theory. So tomorrow we are going to have portfolio theory so that you know more about portfolio risk and the types. Okay, so like I was trying to say, the capital asset pricing model asserts that the expected return of assets will change only by their systematic risk as measured by the beta. Okay, so systematic risk is the same thing as beta. So since the unsystematic risk can be eliminated through diversification, okay, because unsystematic risk is avoidable, is diversifiable, but the systematic risk is not diversifiable. So as a result, the focus generally is on the systematic risk, which cannot be diversified, okay, which cannot be diversified. Now, according to capping, two assets with the same beta will have the same expected return, irrespective of the nature of the assets. That is, given the relationship between risk and return, all assets are defined only by their beta risk. The beta risk is a systematic risk, okay? It's a market-imposed risk, all right? So that's basically the introduction about capital asset pricing model. But one thing you need to understand is that, like I've mentioned, there are three areas of application of capital asset pricing model. One is to price risky asset analysis. This is very common in practice. When you want to determine the price of stocks, of course, you use capital asset pricing model, because there are two sides to the capping. We talk about the expected return and the premium, okay, that needs to be added because of the additional risk that investor will take to compensate investor for undertaking the additional risk. So we get there. Now, of course, you also use capping to determine expected return. So far, we have not talked about the expected return, but we have talked about the other parts of the uses of capital asset pricing model, which is calculating cost of capital. All what we have been doing since the beginning of this diet to date is all about calculating cost of capital using capital asset pricing model. So you're already familiar with that. Now, what are the underlying assumptions of capping? And this is an examinable area, so don't joke with it. In most cases, examiner do ask the underlying assumptions of capital asset pricing model. So the first one is that investors are risk averse, utility maximizing, and rational individuals. What do you mean by risk averse? A risk averse investor is a rational investor that do not like risk. Utility maximizing, despite the fact that investors do not like risk, they also want to maximize their satisfaction. Okay, they want to maximize return, but again, it's not possible in an efficient market for you to be able to. You want to maximize your return, but you don't want to take higher risk. So that's not attainable. In any case, investors are also rational individual. A rational investor or rational individual is the one that is familiar with the dictates of the market. All right. So you understand the risk return trade-off. All right. So yeah, that is a rational investor. Now, the second part of the assumption is that markets are frictionless, including no transaction cost and no taxes. That is not possible. There's no way you are going to make investing decision without incurring transaction costs. And then, of course, once you make a profit, you are expected to pay tax. But the assumption is saying that there is no tax. Number 3, investor plan for the same single holding period. Okay. Number 4, investors have homogeneous expectations. All right. Again, that is not realistic. We are different individuals with different exposure, with different experience. So how can we have the same expectation on the investments? But again, it's a mere assumption. Number 5, all investments are indefinitely or infinitely divisible. Okay, all investments are infinitely divisible. All right, how is that possible? Well, it's an assumption. Then the last one, investors are price taker, meaning that whatever the market push to the investor is what they are going to accept. So they don't have control over price. Investors do not have control over price. It is the market that determines the price to be traded. All right. So just master, make sure you go through the assumptions and get understanding of them. Yes, like I've already mentioned this, the general idea behind capping is that investors need to be compensated in 2 ways. One is for the time value of money and the risk they are undertaking. The time value of money is represented by the risk-free rate of return in the formula of capping, okay? And then compensate the investor for placing money in any investment over a period of time. So the risk-free rate of return is customarily, of course, you already know, when you talk about risk-free rate of return, is the rate of return associated with government security, like government bond or treasury bills. So now, that is on one side of the idea behind capping. On the flip side of the formula of capping, it represents the risk and calculate the amount of compensation the investor needs for taking an additional risk. This is calculated by taking a risk measure, that is the beta you normally have before the bracket in your capping, that compares the return of the asset to the market over a period of time and to the market premium. The additional risks, the investor will need to be compensated for taking a risk. So that additional risk that the risk that the investors are undertaking will be compensated by the risk premium. All right. So that's the difference between the market return and the risk-free rate of return. So that difference is the premium that investor is demanding for taking additional risk. Now, how could you be calling me while class is going on? Now, before we talk about how to estimate capping, or let's just, of course, you already know how to calculate capping. Yes, you already know the formula for calculating capping, which is the risk-free rate of return plus beta multiplied by market return minus risk-free rate of return. This is the formula for calculating capping that we'll be using all this while. Okay. The major focus, like I said, you're already familiar with this formula, but the main focus of capping is on the systematic risk. Okay, so let's talk about the systematic risk. In the formula of capping, you have the risk-free rate of return plus the risk, including the premium. Now, let's talk about this risk, which is beta. Let's talk about that beta. Of course, beta is used to measure how sensitive an asset return is to the market as a whole. When you want to determine the risk of an asset or of a security, you use beta value because beta is a measurement of risk. And then the higher the beta, the riskier the investments. So there are two types of beta. Majorly, there are three types of beta. There's a positive beta, there's a negative beta, and then zero beta. A positive beta indicates that the return of an asset follows the same direction as that of the market. So any event that affects the market will also affect the return of the assets. Okay, but a negative beta, demonstrates or indicates that the return of an asset moves in the opposite direction of that of the market. So I repeat again, a positive beta indicates that the return of an asset moves in the same direction of that of the market. Okay, the return of an asset moves in the same direction as that of the market. While a negative beta indicates that the return of an asset moves in the opposite direction of the asset. So that is positive and negative beta. For the zero beta, a zero beta, of course, is saying that a zero beta shows that the return of an asset has no correlation with that of the market. A zero beta indicates that the return of an asset has no correlation with that of the market. One thing you need to understand is that the beta of the market is always 1. I repeat, the beta of the market is always 1. That is, the risk of the market is always 1. So if the beta of the security of the asset is less than 1, it means that the asset is less risky relative to the market. But if the beta of the security is higher than 1, it means that the security or the asset is riskier relative to the market. So you use the market beta to measure the beta of the securities. So provided the beta of the security, if the beta of the security is less than 1, that means it is less risky relative to the market. But if this is higher than 1, then it is riskier than that of the market. So note that. Then let's talk about how to compute beta value. There are 5 different ways you can compute beta value depending on the information available. And then you have to master all the 5 because you don't know the areas where examiner will test on that day. And that's why it is important for you to know all of them. But I'm going to explain it to you in order of priority, in order of frequency in the exam. Now, when you want to compute beta value, if in the question you are given correlation coefficients and then standard deviation, if you are given correlation coefficients, okay, let me put something down. Based on priority, this is the most frequent. So this, whenever you are given correlation coefficient and standard deviation, let me put it down. This is used when correlation, please mute yourself. When correlation coefficients and standard deviation are given. So whenever in a question you see correlation coefficient, which is R, and then standard deviation, you need nobody to tell you that when you want to calculate your beta value, you are supposed to calculate your beta as correlation coefficient multiplied by the standard deviation of security over standard deviation of the market. So this is the formula. This is the most frequent. This is the most frequent formula that is being used whenever you want to calculate beta value. Okay. The second one is when you are given covariance of security. When you are given covariance of security and you're also given the variance of the market, in that case, this is the formula you are expected to use. So this is used. This formula is used when covariance and variance are given. Okay, when you are given covariance of the security as well as the variance, then this is the formula you are expected to use. So to do this, to calculate beta, is simply covariance of security of the market over variance of the market. Okay, over variance of the market. So that will give you the beta value. Once you go to the question, you can see covariance and then variance of the market. Of course, you need nobody to tell you that this is the formula that you are supposed to use. The next one is when you are given regression analysis information. So when you are not even that, when you are given share price, okay? When you are given share price, let me see. Okay, it's not here. Okay, let me include it. So the third one, the third most frequent is calculated as, the third most frequent formula to use is calculated as the beta will be equal to total weight divided by total market value. So this will give you the beta. of course, you cannot just go to the question and pick total weight and total market value. You have to compute it. So how do you compute total weight and total market value? There is a format you are expected to use. Is it true that I don't have it? I didn't notice that. Okay, let me just give you the format. So if in the question, you only use this weighted average method, you use the weighted average method, if in the question, you can see information of share price, beta value of individual security, okay? Or you're also given the number of shares. In this case, you are expected to use the weighted average to compute the beta value, because examiner will never tell you to use a particular method to compute your particular formula or method to compute your beta value. It is implied in the question. So, and that's why I'm taking my time to explain all of this. So if in the question, you can see number of shares, you can see selling price, that means you need to calculate market value. So once you get your market value, of course, examiner will also give to you the beta of individual security. So if you are not given the beta of individual security, of course, there will be information for you to be able to compute it. Then you calculate it. Then you now determine the weighted average. So once you get the weighted average, then you now go ahead and compute the beta value. So like I said, the first column, some of you are very stubborn. You will not, I said, please mute yourself. Always mute. If you are not asking question, mute. If you want to ask question, just raise hand. Please always mute yourself. You are distracting the class.
Please, can you just go up slightly, that last page, just for 1 second? Just wanted to check something. Just 1 second, please. No, up where you wrote before. No. Yes, please. Okay. You have gone too far. Please.
Okay.
Thank you.
Is it okay now?
I'm fine. Thank you.
Can I scroll down now to continue?
Yes, you can scroll down.
So, to get the total weight, there are about 5 or 6 columns that you are going to create. The first column will be, of course, the investment in the portfolio. Say, for example, you have invested in some companies. Okay, you create a column for that. Let's say you have investments in company A, B, C, for simplicity. Then, of course, you are also given number of shares. You are given number of shares. Then you also have market price. You have market price of each security in the portfolio. So here is market price per share. Let me write that. What's wrong with you? Okay, market price per share. Then you are going to have the total market price. So you are going to be given the beta value of individual security. If you are not given, then you need to go and compute the beta value of individual security. But in most cases, it will be given to you. Then, of course, you are going to calculate the weights. So this is A, this is B, C equal to A times B. Let me push the one down. A, B, then C. Now, this is D. Therefore, E will be equal to C times D. C times D. Okay. So these are the 5 columns that you're expected to create whenever you want to compute beta value when you are given information on share price, number of shares, and at the same time, you are given beta value of individual security. So just put the number of shares as given to you. All right. The market price per share will also be given to you. To get the total market value, you multiply the number of shares with the market price per share. for each of the security. Then you get the total market value. The beta of individual security will also be given to you. If not given, of course, you need to, but it to be given to you in most cases. Then to get the weights, just multiply the total market value of individual security with the individual beta value. Okay? Then you add all of this together. To now get the beta overall, to get the risk of the portfolio, that is the overall beta value, you are expected to divide the weight, the total weight with the total market value. That's the formula you have here. So for you to get your overall beta value, or that is the beta of the risk of the entire portfolio, then it is total weight divided by the total market value. So this is the third most frequent formula to be used to compute beta value. The fourth one is when you are given regression analysis information. When regression analysis information is given, then of course you are supposed to use the fourth one as your formula for calculating beta value. I've told you, Niyi, please mute yourself. I've told you guys to mute yourself. You are distracting the class. Leke, please mute yourself. You are not talking. Why do you put on your speaker? You are distracting the class, please. I have the right to remove you if you continue to distract my class. I've told you if you want to talk, you raise your hand. Yes, Jacob, talk to me.
All right, sir. I wanted to just confirm that I don't put these formulas at the back of the question, right?
Jacob, no, they can't put all the formula at the back of the question. So on the day of your exam, there are about 7 formulas that will be given at the back of your question paper. This is not one of them.
Okay.
These are very straightforward forms, so it won't be given to you. In fact, in most cases, the 7 formulas that you have, they may not be relevant. So it's important for you to master them. All right? Okay, then. So, yes, I said the fourth most frequent formula to be used for calculating beta value is when you are given regression analysis information. As a result, when you want to compute your beta value, you pick N is the number of period. It could be January to December. You can just be given period 1, 2, 3, 4, 5, depending on the information given in the question. So X represents the return on the market portfolio. Y represents the return on the security. Therefore, when you want to calculate the beta value, it is computed as N summation XY minus summation X summation Y over N summation X squared minus summation X all squared. So in statistics, you have done previously you guys will never listen. If I remove you now, you say I'm too wicked. How could you be distracting the class? I told you to always mute yourself. If you want to talk, raise your hand. Please don't let me repeat this. Ella, you raise and talk to me.
Good morning, sir.
Good morning. How are you?
I'm fine, thank you, sir.
Yes, talk to me.
That is solo. We didn't get the link on time, so please, can you do
No,
of
it has been shared. It has been shared since yesterday.
the
No,
one?
sir. Even those at VI, we didn't get the link.
It was 4:30.
Sorry about that.
That's true, sir. We didn't join the class until like 8:30 or 8:20.
The link?
Yes, sir.
Yes, sir. The one that was sent earlier was we couldn't log in. The time was even 4:30.
I wasn't aware because once I joined the class, I don't know what is happening on the on the WhatsApp group. My expectation is that okay, everybody has received. I didn't know the other one was not working. Yeah, sorry about that. Sorry. So is that all, Ella?
Yes, sir. Please, I just wanted you to do a recap, sir.
Okay. Before we solve illustration, I will do a brief recap. But for now, let's move on. All right. So you can put down your hand and mute. Okay. So, like I said, the fourth most frequently used formula for calculating beta value is when you are given regression analysis information. So beta value will be computed as n summation xy minus summation x summation y over n summation x squared minus summation x all squared. Okay. So that is the formula for calculating beta value. X is the return on the market of the portfolio, while Y is the return on the security. Of course, N is number of period. You can be given 12 months, January to December. It could be 5 months, it could be 6 months, it could be 3 months, whatever it is, the number of period will be given to you. Just like you normally do when you are calculating regression, we want to calculate a slope. Okay, you want to calculate slope under statistics. You know, period is usually expressed in number of years, all right? So, or months. So it's the same thing here. Now, the last one is if you are given excess return on security as well as excess return on the markets, okay? In that case, you are supposed to use this formula. This is the fifth formula that you can use to compute the beta value. So the excess return on security is the difference between the expected return and the risk-free rate of return, okay? Then the excess return of the market is the risk premium, that is the market return minus the risk-free rate of return. So that will give you the excess return on the market, okay? So these are the 5 different formulas that you can use to compute beta value. Like I said, when you want to compute your expected return of the portfolio or of the assets using this formula for CAPIMS. Under CAPIMS, examiner will not give to you the beta value. This beta value will not be given to you. All right. And that's why you have to go ahead and compute the beta value first before you compute your expected return. Remember what I told you when we started this capping? I said the major focus of CAPIMS is on the expected return and the systematic risk of a given asset. All right, systematic risk of the asset, because you can the unsystematic risk can be diversified, but the systematic risk, which is what we also know as a beta risk, okay, and it's not diversifiable. So as a result, focus is on that, the one that is not diversifiable. So to do this, when you want to calculate your expected return, the beta value will not be given to you. My explanation is now that there are 5 different ways you can compute your beta value. And that's what I have to take you through all of that one after the other, because on that day, if you have a question on that CAPIM, there is no way you are going to struggle if you don't know how to compute your beta value. So all these 5 formulas I just mentioned now, you have to go through them, you have to master them, and you know which one to use. Like I said, the most frequent one is when you use this particular formula. This is used if in the question you are given correlation coefficient and the standard deviation of each security. So when that happens, this is the formula that you are expected to use. That's the most frequent. The second most frequent formula to be used to compute beta value is if you are given covariance and the variance of each security. Okay, when you are given covariance and variance of each security, then in that case, you are supposed to calculate your beta value as the ratio of covariance of the security of the market over the variance of the market. That is, you use this formula. Then the third most frequent method is whenever you are given you are given share price, you are given number of shares, and you are also given the beta value of individual securities. In that case, you are supposed to use weighted average method to calculate your beta value. So you use weighted average method to calculate your beta value. So for you to be able to calculate your overall beta, you need to first of all go ahead and calculate the total market value. You also calculate the total weight of the security in the portfolio. So using this particular format, okay, that's the format you are expected to use. To do this, of course, you create a column for the investment in the companies, then the number of shares as given to you, the market price per share as given to you. Then to get the total market value, you are expected to multiply the number of shares with the market price per share or market value per share to get your total market value. Then the beta value will also be given to you. For the beta value of individual security will be given to you. Then to get the total weight, just multiply the total market value with the beta value of individual security. So once you have the total market value and the total weight, then you can then proceed to calculate the overall beta of the portfolio, which is the ratio of total weight over total market value. So that's that. Then the fourth one I said is when you are given regression analysis information. So in that case, you are supposed to use this particular formula. And the last one is when you are given excess return on security and excess return of the market. And I said the excess return on security is simply the difference between the expected return on security and then the risk-free rate of return, then over the market return minus the risk-free rate of return. The market return, the difference between RM and RF is the risk premium, okay? So those are the formulas that you can use. Those are the formulas that you can use to compute. I don't know why some people are just stubborn. Princess, don't let me call your name again. Always mute yourself. I can't continue to remind you. Always mute yourself. Muhammad, mute yourself. Even if your environment is quiet, always mute yourself. I don't want to see I don't want to see your speaker on. If you want to ask question, please raise your hand. Yes. So the only thing, there's nothing I've talked about, Ella. So there's nothing I've talked about that we don't have it. The only thing you need to understand is the fact that I mentioned that there are 3 types of beta. Okay, there are 3 types of beta. We have a positive beta, negative beta, and at the same time, we also have zero beta. And I said that the positive beta shows that the return of an asset will move in the same direction of that of the market, while the negative beta indicates that the return of an asset will move in the opposite direction of that of the market. And then the zero beta indicates that there is no relationship, there is no correlation, no relationship between the asset return and that of the market. One important thing you also need to note is that the risk of the market, the beta of the market, is always 1. I repeat, note that the beta of the market is always 1. So what this simply means is that once you have gone ahead to compute your beta value of the security using any of these 5 formulas, if the beta value you got is higher than 1, it means that the risk of the security is higher relative to that of the market. If the beta value you computed is less than 1, it means that the security is less risky relative to that of the market. So this is the thing you need to know, because at times examiner can ask you to explain that or to discuss. So you must be able to juxtapose accordingly. Okay, so you are using market risk, which is 1, as the basis, as a benchmark on the risk of the securities in the portfolio. Okay, then. So these are all the explanations in relation to CAPIMS. So we started with the definition of capping, and we talked about the fact that capping is a model designed principally to establish the relationship between expected return and the systematic risk of an asset, particularly stocks. And then we said that there are three main uses of capping. Capping can be used, okay, to price risky assets. And we said risky assets is generally stocks, that is shares, all right? Then two, cappings can be used to compute expected return of an asset. Then number three, capping can be used to determine cost of capital. So these are the three main uses of capping, especially to price risky assets. Is very, in practice, that is very common. But again, theoretically, there is no, oftentimes when you want to compute cost of capital and then you are given vital information, you are expected to use capping for that. Okay. Then we also talk about the underlying assumptions. And I said these underlying assumptions of capping are examinable areas, and you have to master them. You have to master them. At least you'll be able to memorize 5 of them. Okay. And we talked about each of them. But yes, these are all the explanations or the concepts of cappings. So let's move to calculation. Now, before we go to calculation, there's one more thing. There are two examinable areas in capping. We have talked about one. Let's talk about alpha value, computing alpha value. Let me see. Oh, it's not here. Okay. In that case, let me see if I can get a space to explain alpha value. Okay. Let's talk about alpha value. We have talked about beta value. Let's talk about alpha. Let's talk about alpha. Okay, let's talk about alpha. What do you understand by alpha? Alpha represents the difference between expected return and the required return of an asset in a portfolio. I repeat, alpha represents the difference between expected return and the required return of an asset in a portfolio. So it can be computed as the difference between expected return and then the required return. Alpha is denoted as this. It is computed as expected return minus required return. You can call it RS or RR, required return. So the difference between these two is what will produce alpha. How do you then compute alpha? To calculate alpha, there's a particular format that you're expected to use. Okay, calculating alpha. So to calculate alpha, you create a column for the companies. Say, for example, you have company A, company B, investment in company A, B, and C. The expected return, in most cases, will be given to you. Expected return will be given to you. The required return, which is RS, will never be given to you. You are the one that will do it. Then, of course, the next column will be to compute the alpha. If you like, you can then introduce additional column for comments. Okay, additional comments, additional column for comments. So now, this is A, this is B. C is equal to A minus B. Okay, so that's that. I will have this, this, and that. This, and that. I will have my alpha. So this is the formats that you can use to compute the alpha value. Okay. Now, when you want to compute the, like I said, in most cases, the expected return will be given to you, but the required return will not be given. How do you then compute the required return? Of course, the required return will be computed as your capping, the formula for capping, which is risk-free rate of return plus the beta value multiplied by the risk premium. Okay, so that's the formula. You're already familiar with this formula. So you must first of all go ahead and compute the required return before you come and compute your alpha value. Now, in most cases, to get your required return, RS, you will need to first of all compute the beta value, because this beta value will also not be given to you. And that's what I've given you those 5 formulas before. So you need to go ahead and compute the beta value using those formulas. The 5 formula, any of those 5 formulas will be given on that day. So once you have your beta value computed, then you can then come around and compute your the required return. Okay, compute the required return. So once you have the required return, then you put it in the formats. Therefore, expected return minus the required return will give me alpha value. Now, once you have computed the alpha value, you need to interpret your results. Therefore, how do you interpret your alpha value? So, interpretation, it is important. You must know how to interpret your results. Interpretation. Number 1, if expected return is greater than the required return, it means that the security is on. Okay? This means the security in the portfolio, the securities are underpriced. The security is under, you can say underpriced or undervalued. So since the expected return is greater than the required return, and you said that it is undervalued, so if the security is undervalued, what are you supposed to do? Therefore, since the security is underpriced, then the security, more of the security should be bought because it is underpriced. The intrinsic value is more than the actual value. So as a result, then you need to buy more of it so that in the future, when the price increases, then you can dispose of to make more gain at disposal. So this means that the security is undervalued, hence more of it should be bought. Hence, more of it should be purchased. You buy more and you keep it. When the price increases in the future, then you dispose. You make more money. Then number 2, if expected return is less than the required return, this implies that the security is overvalued. So if the security is overvalued, what are you supposed to do? You dispose it off. Therefore, the security should be disposed of. So you sell it. Okay? Then the last one, number 3. If expected return is equal to the required return, this means that the security is properly priced, is properly or rightly priced. So what are you supposed to do with it? Then you hold on to it. Okay? Therefore, the company or the investor should keep the security, should keep or hold on to the security. That is, the security should be kept. So that's what you need to do if the expected return equates the required return. But one thing you need to understand is that in order not to confuse yourself, if the alpha value is positive, another interpretation is that if alpha value is positive, it is undervalued. But if alpha value is negative, it is overvalued. Okay, it is overvalued. If alpha value is 0, then of course it is properly priced. Okay, so this should be clearer. All right, this should be clearer. So once you have computed your alpha value and it is positive, you should know that it is underpriced. If it is negative, it's overpriced. If it is 0, then it's, of course, that means it is properly priced. So these are the things you need to take into consideration. It is not sufficient for you to just compute your alpha value and you said that, oh, it is undervalued, overvalued, or rightly priced. You must explain, you must advise what they should do with the security. And that's what I've told you. Once it is positive, that means it is undervalued. If it is undervalued, then more of the security should be bought. If your alpha value is negative, it means that, of course, the security is overvalued. If it is overvalued, then the security should be disposed of, it should be sold. Then the third one is that if your alpha value is 0, then of course it means that the security is rightly priced. If the security is rightly priced, then the company should keep it. The company should hold on to the security. All right. So these are the things you need to take into consideration as far as alpha computation is concerned. You know, I mentioned to you, I don't know, I can't remember clearly, sometime around May or June, I wrote an article on the investing decision and the factors you need to take into consideration. I also talk about share price, how to determine share price of a company and all of that. So when you are making investing decision, you need to you need to determine the price, to know whether the shares are undervalued or overvalued. These are the things we are talking about. So it's practical. So it's practical because this will enhance your investing decision. But in any case, let's move on. So at this point, I've explained all relevant concepts in CAPIMS. So let's now have calculation. Let's have calculation. If I'm able to solve 4 illustration, I'll be okay. I'll be okay. So I'll pick 2 illustrations under normal CAPIM. Then I'll pick another 2 illustrations for alpha value. Okay. So let's go through it together. Okay, let's solve this illustration number 1 as a refresher. Okay, we have done this previously, but again, let me push it to you. Yes, I need somebody to read for us. Who will help us to read? Yes. Who will help us to read illustration 1?
Jalingo PLC is all equity company with a beta of 0.8. The risk-free rate is 10%, and the expected return on the market is 18%. Jalingo PLC increases its gearing to a debt equity ratio of 0.5. Income tax is 35%. Required 1. Compute Jalingo PLC's cost of equity when ungeared. 2. Compute Jalingo PLC equity beta when geared up. 3. Compute Jalingo PLC's cost of equity when geared. 4. Check the answers to 1 and 3 using the M&M formula.
Okay, thank you very much. That is the question. That is the question. I will stop sharing this and move to the working note. Please open to the question at your end so that we follow through together. So the name of the company is Jalingo. Solution to illustration 1. Jalingo, is it a PLC? Yes, Jalingo PLC. Now, requirement number 1 says that you should compute Jalingo's PLC's cost of equity when ungeared. Please, you have to participate in this question. In solving this question, because I'll be asking you a question. When I ask a question, if you know it, raise your hand. Don't talk randomly. Just raise your hand, then you talk. So, examiner is asking us to compute Jalingo PLC's cost of equity when ungeared. So let me start with the first one. We want to calculate cost of equity when ungeared. Roman figure 1, cost of equity when ungeared. What's the meaning of this? Examiner wants you to calculate ungeared, cost of equity ungeared. So you have to calculate cost of equity when ungeared. That is, calculate cost of equity ungeared. That's what the examiner wants you to do. Therefore, based on the information given in the question, how do you calculate cost of equity ungeared? Remember, I said when you want to compute cost of equity, there are 3 different methods you can use to compute your cost of equity. You can use dividend valuation model, you can use capitalized pricing model, or you use Miller and Modigliani formula to compute your cost of equity. So examiner is now asking you to compute cost of equity when ungeared, meaning that you are going to use ungeared beta to calculate your cost of equity. So if that is the case, what information do you have to compute cost of equity ungeared in this question? Of course, there is nothing like dividend, so dividend valuation model is out of it. Do you have information of capping? Yes, we are given information of capping. That means we are supposed to use capping to calculate cost of equity ungeared. What do you mean by information of capping? In the question, you can see risk-free rate of return of 10%. You can see expected return on the market of 18%. So what else? You are also given beta. So what else do you want? That means we have all the information required to compute cost of equity ungeared. Therefore, I would then say cost of equity ungeared will be computed as the risk-free rate of return plus the beta value, that is ungeared beta, multiplied by the market return minus risk-free rate of return. So this is the formula to compute the cost of equity ungeared. The risk-free rate of return as given in the question is 10%. Therefore, for me to be able to get the cost of equity ungeared, I need ungeared beta. I will then go to the question, which beta is given to me? Examiner has told us that Jalingo PLC is all equity company with a beta of 0.8. That 0.8 is an ungeared beta because Jalingo PLC is an all equity company. So the beta of an all equity company is the gear beta. Remember, when we did project-specific cost of capital, we said the beta you identified, the proxy beta you identified in step 1 will be geared if the proxy company has debt in its capital structure. So in this particular question, the examiner is telling you that Jalingo PLC is an all-equity company. That means there is no debt. There is no debt in the capital structure of Jalingo. So if that is the case, the 0.8, which is on gear beta, then I will then come and put the on gear beta, which is 0.8. I will go back to the question. What is market return? Market return, RM is the market return. So according to the question, market return, the expected return on the market is 18%. So here is 18 minus risk-free rate of 10. Mathematically, bring out your calculator. 0.8 multiplied by 8 plus 10. That's 16.4%. 16.4% is the answer. So cost of equity. What's wrong with you? So cost of equity on gear is 16.4%. So this is cost of equity when ungeared. That's the cost of equity when ungeared. Then the second requirement is saying that you should compute Jalingo PLC's equity beta when geared. Remember, you have to understand the requirement. You are asked to compute Jalingo PLC equity beta when geared up. You want to calculate equity beta. You are not calculating cost of equity. You want to calculate equity beta when geared. That is beta equity of a gear. Again, we did project-specific cost of capital, requirement number 2, equity beta when geared. Okay, equity beta when geared up. That is, you want to calculate cost of equity of a gear. So when we did project-specific cost of capital, I told you that cost of equity of a gear is computed as beta assets multiplied by beta asset multiplied by 1 plus 1 minus tax, debt equity proportion, okay, debt equity proportion. So this is the formula for calculating cost of equity of a gear. Sorry, to calculate, yes. What am I saying? Beta equity. This is beta equity of a gear. Yeah. Precious, please mute.
Sorry.
So, in the question, examiner wants you to calculate equity beta of a gear. So, like I said, you know, when you want to re-gear under project specific, the third step is to calculate beta equity of a gear. And this is the formula I gave to you. So in this question, the examiner is asking you to determine, to compute equity beta when geared up. That is beta equity of a gear, not KE. Beta equity of a gear, BEG. So this is the formula. BA is the asset beta, which is on gear beta. T is the company tax rate. D is the proportion of debt. E is the proportion of equity. Therefore, let's put in the variables. So I don't know the BEG, beta equity of a gear now. Let's go to the question. If you are given asset beta, according to the question in the first paragraph, you are told that Jalingo PLC increases its gearing to be a debt equity ratio of 0.5. So debt equity proportion is 0.5. Then what about the beta assets? The beta asset we are given in the question is 0.8 because you are told that Jalingo PLC is all equity company. An all equity company that has the beta, that's beta of 0.8 is an on-gear beta, which is the same thing as asset beta. So this will be 0.8 multiplied by 1 plus, what's the company tax rate? The company tax rate is 35%. So you are supposed to account for 65. So 0.65. Then multiply by the debt equity proportion is 0.5. Okay, 0.5. That's it. It's as simple as that. So what are you supposed to do? Just use your formula and get the answer. Okay, so I would then say 0.5 multiplied by, 0.5 multiplied by 0.65 equal +1 equal multiplied by 0.8 equal, that's 1.06. 1.06. So the beta equity of a gear is equal to 1.06. That's it. You must know how to interpret a question. All right, the next one. Number 3, you are required to compute Jalingo PLC cost of equity when geared up. Okay, you want to calculate cost of equity of a gear. Since you have computed beta equity of a gear and you are asked to compute cost of equity when geared up, then it means that you are expected to calculate capping using the gear beta. That's interpretation. Number 3, cost of equity when geared. Okay, that is calculate cost of equity of a gear. To do this, the cost of equity of a gear will be equal to the risk-free rate plus the gear beta into market return, the risk-free rate of return. So the gear beta, cost of equity of a gear equal to 10 plus our gear beta we computed is 1.06. The difference between market return and the risk-free rate of return is 8. That is 18 minus 10. Therefore, what do you get? 8 multiplied by 1.06 equal plus 10 equal, that's 18.48. So cost of equity of a gear equal to 18.48%. That's it. That's what the examiner wants you to do. The last one, check the answer to 1 and 3 above using the M&M formula. So examiner wants you to calculate the same cost of equity of a gear using M&M formula. So number 4 requirement. So number 4, cost of equity of a gear using M&M. So calculating cost of equity using M&M. According to M&M, cost of equity of a gear is equal to cost of equity on gear plus, open a bracket, cost of equity on gear minus cost of debt multiplied by debt value into 1 minus tax over our equity value. So this is the formula for calculating cost of equity of a gear using M&M formula. So the cost of equity of a gear, we have computed it to be 14%. So to be 18, is it 18? Let me check again. We computed cost of equity. Okay, we computed cost of equity to be 16.4. There are different ways you can do this. There are different ways we can calculate whatever we want to do. However, so since we are calculating cost of equity of a gear and your examiner is asking you to use information number 1 and 3. So information number 1 and 3. So this cost of equity of a gear is what we want to calculate. That is unknown. So the cost of equity on gear we computed in requirement number 1 is 16.4% plus 16.4 minus cost of debt. Cost of debt is interest rates on borrowing. In the question, we are not given anything like interest rate on borrowing. Whenever the cost of borrowing is not given, what do? You assume the risk-free rate of return. Therefore, the 10% risk-free rate of return will be assumed as the cost of borrowing, cost of debt. Therefore, I will then come here 10 into, then multiply by debt value. Examiner has told us debt equity proportion is 50%, 0.5. Therefore, I would then say 0.5, which is the debt equity proportion. The value of debt and equity is 0.5. Then multiply by the tax rate. 1 minus tax rate is 0.65. So mathematically, cost of equity of a gear will then be equal to 16.4 plus the difference between 16 and 10 is 6.4. Okay, 6.4 multiplied by 0.5, 0.5 multiplied by 0.65 equal, that's 0.325. Okay, 0.325. So then my K cost of equity of a gear will then be equal to 16.4 plus 0.325 multiplied by 6.4 equal 2.08. Here is 2.08. When you add the two together, okay, 2.08 plus 16.4, that's 18.48. This is 18.48. So using Miller and Modigliani formula, our cost of equity of a gear is the same as computed in number 3 requirements. This is number 3, cost of equity is 18.48. Using Miller and Modigliani is also 18.48. That is what examiner wants to achieve, and that's why you are asked to do it. Let me know if you have any question on this so that we can move to the next illustration. So,
Yeah.
yes, talk to me.
I don't know how to raise my hand up. Please, can you go to the first solution? Please, sir.
Okay. This one.
Yes. Okay, thank you. Can go.
You're welcome. Then mute. Okay. Yes. If there is no question, let's move to another illustration. I will stop sharing this and move to the notes. Let's have illustration number 2. Let's have illustration number 2, Prince Fernandez. Another scenario. Who will help us to read? In fact, let me look at you. All those of you that have been making noise since, you are going to pay. There's a consequence for Leke. Adeleke, if you are there, let me see. Adeleke,
Yes.
read.
Okay. Prince Fernandez, a valued client of your stockbroking firm, has asked for your advice on his investment portfolio.
Ghanaians, hold on. Not even you. There is an Adeleke solo student because he has been disturbing my class since. I wanted him to read, but it's like he's not online again. Yeah, read on. You can go ahead, Ghanaians.
Okay. He holds the following securities in the firm market, having the listed risk characteristics shown below, which is regarded as efficient, standard deviation, correlation coefficient, and amount invested. The staff of the investment department of your firm has estimated the expected return on shares in general. On the basis of past returns and inflammatory expectations to be 20%, it is expected that the risk premium will be about 5%. The risk of the market as measured by standard deviation is 8%. All the three shares lie on the securities market line. As a prelude to your advice, prepare the following completion for a discussion within your clients. 1, the expected returns of your client's portfolio. 2, the risks of the portfolio, assuming the capital asset pricing model CAPM approach.
Thank you very much, Ganiyat. Yes, that is the question. This particular question has been tested twice by the examiner. However, in the first requirements, you are expected to compute the expected return of your client's portfolio, and the risk of the portfolio. Examiner is asking you specifically that you should use capital asset pricing model approach. All right. So examiner was specific as far as this question is concerned. Therefore, you want to calculate expected return of the portfolio. There is different, the way you compute expected return of individual security is different from the way you compute expected return of the portfolio. All right. Therefore, how do you answer this question? First thing first, before you can calculate the expected return of the portfolio, you must compute the expected return of individual security in the portfolio. As far as this question is concerned, there are three securities: security X, Y, and Z. Okay, we have security X, Y, and Z. Therefore, you must compute capping for each of the security. Now, for you to be able to compute the capping, you can see in this question, we are not given beta value. Therefore, you must first thing first, compute the beta value before you can compute the capping for each of the securities. So the bottom line, the question line is that, how do you compute your beta value? Remember, I gave you 5 different formulas. And I said that whenever correlation coefficient and standard deviation is given, then the beta value will be computed as correlation coefficient multiplied by the standard deviation of the security over standard deviation of the market. So in this question, you can see standard deviation, you can see correlation coefficient. So without wasting time, let me stop sharing this and move to the working notes. So first thing first, you have to compute the beta value. That's your starting point. Solution. So illustration 2. Prince Fernandez. Okay, that's the name of the investor. So you're now told that you want to compute the return of the portfolio. Like I said, there is no way you can just go ahead and compute the return of the portfolio without computing the expected return of individual security. So your starting point is to calculate beta value of individual security. So calculating beta of individual security. Then I will then go to the question, how do I compute my beta value? In this question, you are given correlation coefficient and standard deviation. Therefore, beta value will be computed as correlation coefficient multiplied by the standard deviation of security over standard deviation of the market. So I will then do for security X. For security X, beta of security X, I will go to the question, what's correlation coefficient of X? Correlation coefficient of X is 40%, which is 0.4. 0.40 multiplied by standard deviation of security X. is 15%. Okay, so 0.15 divided by the standard deviation of the market. Let's go back to the question. What is the standard deviation of the market? Examiner has told you that in the last paragraph, in the paragraph after the table, the last sentence there, you are told that the risk of the market as measured by the standard deviation is 8%. So risk of the market represents the market risk, okay? So, of course, we are told that it's 8% as measured by the standard deviation, 0.08. So that's standard deviation of the market, 0.08. So what do you get? 0.4 multiplied by 0.15 equal divided by 0.08 equal 0.75. The beta value of security X is 0.75, which is less than 1, the beta of the market. Then we do for security Y. For security Y, the correlation coefficient is 60%. The standard deviation of security Y is 14%, or 0.60 multiplied by 0.14 divided by 0.08, which is standard deviation of the market. So this will give us 0.6 multiplied by 0.14 equal divided by 0.08 equal 1.05, which means that security Y is slightly riskier, okay, than the market. Okay, it's riskier than that of the market. The risk of security Y is higher than that of the market. Then for Z, for security Z, okay, the correlation coefficient is 80%, standard deviation is 5%. 0.8 multiplied by 0.05 over standard deviation of the market, which is 0.08. This produces 0.8 multiplied by 0.05 divided by 0.08 equal, that's 50%, 0.5. Again, security Z is less than the risk of security Z is less than that of the market. Okay, so now that we have computed the beta value or the risk of individual security, you can then go ahead and compute the expected return of individual security. Okay, number 2, expected return of individual security, okay, denoted as RS. Therefore, RS is equal to the risk-free rate of return plus the beta value into market return minus the risk-free rate of return. All right. So RS for security X is will be computed as, then go to the question, what's the risk-free rate of return? What's the risk-free rate of return? You are told that the staff of the investment department of your firm has estimated the expected return on shares in general on the basis of past return and inflationary expectation to be 20%. That 20% is the market return, because the examiner told you expected return on shares in general. So that is market return, which is 20%. It is expected that the risk premium will be about 5%. So in this question, the examiner did not give to us the risk-free rate of return, but you have been given market return to be 20%, the risk premium to be 5%. So with this information, we should be able to compute the risk-free rate of return. Therefore, like I said, So in this question, the examiner gave you, let me push this thing up. Now, in this question, you are given market return to be equal to 20%. You're also given risk premium. Risk premium is different between market return and the risk-free rate of return to be equal to 5%. Okay? Therefore, how do you get your risk-free rate of return? It means that your risk-free rate of return, which is RF, the RF will then be equal to the market return, okay, will be equal to market return minus the difference between market return and then the risk-free rate of return. So RF will be equal to 20 minus 5, which is 15%. So risk-free rate of return is 15%. Therefore, I would then say 15 plus the beta of security X. Beta of security X is 0.75. 0.75. The market risk premium is 5. So final answer, 5 multiplied by 0.75 plus 15. That's 18.75. Here is 18.75%. Yes, Jacob, talk to me.
Yes, sir. I kind of got a little bit confused with how you calculated the risk-free rate, the formula. So that where I got confused was the RF is equals to RM minus open bracket RM minus RF.
You know already that the difference between RM and RF is the risk premium, isn't it?
Yes.
Jacob, so if you are given a risk premium to be 5%, as in this case, the difference between RM and RF in the formula for calculating capping, this RM and RF, the difference between the two is 5%. You're also told that this RM alone, the market return is 20%. So how do you then get the RF? Therefore, RF will be equal to the market return minus the risk premium. Market return is 20%, risk premium is 5%. That's all. That's what we did.
All right, I get it now. Thank you.
You're welcome. Now, for security Y, the risk premium, sorry, the risk-free rate of return is still 15 plus the beta value of security Y is 1.05. 1.05 multiplied by 5 equal. So that will be 5 multiplied by 1.05 plus 15 equal 20.25. So the expected return of security Y is 20.25. Then security Z, risk-free rate of return is 15 plus beta of 0.50 into market risk premium of 5. Okay, so 0.5 multiplied by 5 plus 15, that's 17.5. This is 17.5%. You will notice that the higher the risk, the higher the return. When you look at security X, the expected return of security X is 18.75, whereas the risk of security X is 0.75. For security Y, the expected return is 20.25, while the risk of security Y is 1.05. Security Z, expected return is 17.5%, while the risk of security Z is 0.5. So which shows that the higher the return, the higher the risk. Security Y with a higher risk also has the highest risk of 1.05, also has the highest expected return. Security Z with the lowest expected return of 17.5 also has a lower or the lowest risk of 0.5, okay, which is consistent with the modern portfolio theory. We state that given an investor a high level of risk, we will expect the same level of return. And where two securities have the same risk, the same return, we will select the one with the lower risk. In any case, let's move on. So we are done with this. Now that you have computed the risk of individual security, expected return of individual security, we can then proceed to compute. We can then proceed to compute the expected return of the portfolio using capping. So the main requirement now, which is requirement number 1, you are asked to compute the expected return of your client's portfolio. Therefore, the return of the portfolio expected return of the portfolio RP. So the RP, how do you compute this? Examiner says you should use capping approach. So to do this, we are going to pick, since you have computed return of individual security, so you are going to take the proportion of the amount invested on security X. You will multiply it with the expected return of security X. Okay? Expected return on security X plus the proportion invested on security Y. You multiply with the expected return on security Y plus the amount invested, the proportion invested on security Z, you multiply with the expected return on security Z. So that is how you are going to calculate the proportion. You are going to calculate the expected return of the portfolio. Debbie, talk to me. Debbie, you raised hand.
No, sir. Sorry, made mistake.
Okay,
Sir,
then.
can you please help me go to where you were calculating the beta of individual security? I didn't get the second calculation.
Okay. Remember, we are using a formula. Are you true now? Debbie?
Not yet, sir. Not yet, sir. Please calm down a bit. Okay, thank you, sir.
You're welcome. Okay. So the return of the portfolio will then be equal to, I will go back to the question, how much has been invested on security X? We are told that amount invested in percentage, 30% is invested on security X, 40% on security Y, and then 30% on security Z. So if that is the case, 0.3 multiplied by expected return on security X is 18.75. Here is 18.75 plus the expected return. We invested 40% on security Y, multiplied by expected return of 20.25 plus we invested 30% on security Z, which has expected return of 17.5. Therefore, the return of the portfolio will then be equal to 0.3 multiplied by 18.75 equal 5.625. Here is 5.625 plus security Y, 0.4 multiplied by 20.25 equal 8.1 plus 0.3 multiplied by 17.5 equal, that's 5.25. So the return of the portfolio would then be equal to 5.25 plus 8.1 plus 5.625 equal 18.98. Here is 18.98%, approximately 19%. The return of the portfolio is approximately 19%. Finally, you have to compute Roman figure 2. You have to compute the risk of the portfolio. Okay? So, the risk of the portfolio denoted as DP. So the risk of the portfolio will be computed since we have to use capping method. So we are going to pick the amount, the proportion invested on security are X. You multiply with the risk of security X plus the proportion invested on security Y multiplied by the risk of security Y, which is measured by standard deviation, plus the proportion invested on security Z multiplied by the standard deviation of security Z. Okay, so DP, the risk of the portfolio, is 40% multiplied by 0.75 plus, sorry, 30% is the first one, plus 40% we invested on security Y multiplied by 1.05 plus 30% on Z multiplied by 0.50. So the risk of the portfolio will then be equal to 0.3 multiplied by 0.75 equal 0.225. 0.225 plus 0.4 multiplied by 1.05 equal 0.42 plus 0.3 multiplied by 0.5 equal 0.15. Add it up. That's the final answer. Okay. Plus 0.42 plus 0.225 equal 0.795. 0.795. Approximately the risk of the portfolio is 0.80. That's it. That's it. That's the end of the question. Let me know if you have any questions so that we'll move to the next one. Okay. So if there are no questions, let's move to another illustration. I will stop sharing this. Okay, Mr. Adejuwon. Question is RS equal to expected return from individual security has been applied in this question. Expected return of individual portfolio required rate of return. I don't get your question. Speak up. You can speak up.
What I'm trying to ask here is, when you were trying to introduce the formula, the different formula, and you talked about the expected return and the required rate of return. Okay, so in this calculation, what I'm saying, I just want to reconfirm. When we're calculating the ROS for the individual portfolio, that's individual portfolio ROS is equal to the expected return for each individual portfolio, because when we're doing the formula, it seems as if the expected return is different from the required rate of return. But at this point, expected return on
don't mix it together.
If you allow me land.
You are missing it. You have said expected return, required rate of return. Don't miss the two. You only mentioned that
expected return. sorry, this expected return is the question. This is not the calculation. Where I'm going to is this calculation down here.
Yeah.
We said ROS equals to, we use CAPM here.
Yeah.
So this ROS we're calculating here, I just want to confirm this is the expected return for each individual portfolio. That's what we're doing here with this CAPM formula.
Yes.
Okay.
Yes.
Okay, thank you.
Yep. Okay, so let's we stop sharing this. Let's move to alpha. Let's move to alpha. Calculating alpha. So let's have illustration that will help us to demonstrate that how to calculate alpha. Okay. We can come to any one of this one later on, but for now, let's have illustration that has to do with alpha. Okay. Let's start with illustration number, let's do this illustration number 8. Illustration number 8. Yes, somebody should read. Illustration number 8. Illustration number 8. Somebody should read. If you refuse to talk, I will call you. No problem.
Okay, illustration number 8.
Thank you, Debbie.
Smaller Funds PLC has a portfolio of short-term investments in the shares of 4 quoted companies. Figures assumed correct. You have the following additional information. The market risk premium is 10% per year, and the risk-free rate is 6% per year. Required: estimate the beta of SF PLC short-term investment portfolio. B. Recommend, given your reasons, whether the composition of SF PLC short-term investment portfolio should be changed using relevant calculations. Hints: consider the alpha values of the shares and the properties of investing short-term funds in equity. C. Explain 3 factors that a financial manager should take into account when investing in marketable securities. 20 marks.
Thank you very much, Debbie. Yes, in the first requirement, in requirement number A, you have to estimate the beta of Sumala Funds PLC short-term investment portfolio. You want to calculate, you can see in this question, in the table given to you, examiner has already given to you the beta value of individual security. You have the beta value of individual security. So examiner is now asking you to compute the beta value of the portfolio, of the investment portfolio, which means that you are supposed to use weighted average method. Okay, you are supposed to use the weighted average method to compute your beta value. Why do you use weighted average method? In the question, I can see market price per share. I can see beta value of individual security. I can also see number of shares, which means that you have to use the weighted average method. In fact, let me stop sharing this and move to the working notes so that quickly we can solve the question. This is the kind of question you should be praying for, okay? Because you are done, and then move to the next one. So this is illustration number 8. So solution to illustration 8. So the first thing you need to do, of course, examiner wants you to compute the overall beta. You want to compute the overall beta. You already have a format. Number A, so I will say calculating beta or overall beta of Sumola portfolio. I don't need to say that. I'll just come here. According to the question, we have company TPBY. So I will create a column for company T B P Y. Sorry, the other way. Supposed to be P, Pascal, then Binta, Yetunde, Tomiwa. Now, after company, you need to insert number of shares. Then after that, you have market price per share. I will go to the question, examiner give market value per share. So I will say market value per share. I will get the total market value. After that, I will insert the beta value of individual security. Then I will calculate the weight. This is A, this is B, this is C equal to A times B. This is D. Okay, then this is E. E equal to C times D. Okay, so number of shares, call it for me, please. Call the number of shares for me.
100,000.
Pardon?
100,000 number of shares.
100,000 shares,
155,000.
55,000.
260,000.
260,000.
420.
420,000.
420,000 shares. Okay. Then the market price, the market value per share. What do you have?
280.
So 280 kobo. 280 kobo is the same thing as 2.2 naira 80 kobo. So just divide it by 100. The next one.
3.40. 3 naira 40 kobo.
3 naira 40 kobo. Next.
1 naira 50 kobo.
1.5. And the last one.
9.5. That's 9.5.
0.95. Okay, 0.95, which is
I think it should be 0.095.
Oh, okay.
Yes, 0.095.
Okay, 0.095. Okay, then. So let's determine the total market value. So multiply. This will give us 280,000. Before that, before we determine that, let's insert the beta value. What's the beta value of T?
1.55.
1.55. Beta value of T?
0.65.
Okay, next one.
1.26.
And the last one?
1.14.
1.14. So that we use one stone to kill two birds. Okay, then. Of course, this is total. Now, the total market value of T is 280,000. So 280,000 multiplied by 1.55. What do you get?
34,000.
No?
434,000.
434,000.
Is it 34 or 280,000? 434,000. Then 1.55 multiplied by 3.4.
527,000.
527,000 multiplied by 0.65.
342,550.
342,550. Then 260,000 multiplied by 1.5.
390,000.
390,000 multiplied by 1.26.
491,400.
400.
491,400. 420,000 multiplied by 0.095.
39,900.
39,900 multiplied by 1.14.
45,486.
45,486. So add up the total market value and the total weight. Total market value and the total weight. What do you get?
Total market value 1,236,900.
1,236,900. Thank you.
The weight is 1,313,436.
Okay. 436. Now that we have computed total market value and the total weight, the next thing we need to do is to calculate the overall beta. Therefore, the overall beta of Sumala Funds investment portfolio will then be equal to total weight over total market value, which is equal to 1,313,436 divided by 1,236,900. What do you get?
1.06.
1.06. Therefore, the overall, I would then say the overall beta value of Sumala Funds investments portfolio is 1.06. Remember, I told you the risk of the market is always 1. If the risk of the investment is 1.06, it means that Sumala Funds investment portfolio, Sumala Funds investments portfolio is slightly higher than the risk of the market, which is 1. Okay, that's that. I think that's 3 marks, 4 marks. You pocket it. The next one, you have to recommend, given your reasons, whether the composition of Sumala Funds investments short-term investment portfolio should be changed using relevant calculations, and you're expected to use alpha value. So in this case, what am I supposed to do? You want to calculate alpha. The first thing first that you need to do is to go ahead and compute, okay? Is to go ahead and compute expected required return of individual security. In this question, examiner has already given to you the expected return. Expected return should be 21% for T, 12.5% for P, 18% for B, and 18.5% for Y. So the only thing you don't have now is to go ahead and compute the required return. So let's go and do working for required return. So number B, requirement number B, calculating alpha value. So to do this, create a column for company. We have company T, Tomiwa, Pascal, Binta, and then Yetunde. Then you create a column for expected return. You create a column for required return. Then you create a column for alpha. So if you like, you can introduce additional column for comments. It's not compulsory. Okay, so that's that. So Let me draw that. So call the expected return for me. The first one is 21%.
12.5. The second one.
The first one, remind me again.
21.0.
21.0, okay.
12.5.
12.5,
18.0.
18.0.
18.5.
18.5%. That's the expected return in percentage. ER in percentage. So let's go and compute the required return also in percentage. Our alpha will also be in percentage. So let's go and compute the required return. So calculating required return. That is RS equal to risk-free rate of return plus beta into market return minus risk-free rate of return. So examiner has made life easy for us in this one because we have been given beta for individual securities. So for security Tomiwa, I will go to the question, what's the risk-free rate of return as given? We are told that the market risk premium is 10% per year and the risk-free rate of return is 6%. So risk-free rate of return is 6. What's the beta of Tomiwa? According to the question, the beta of Tomiwa, what's that? Beta of Tomiwa is 1.55.
1.55.
So here is 1.55. Okay. Market return. Are we given market return? You are given market risk premium, which is the difference between RM and RF. So we are told is risk premium is 10%. So here is 10%. So what do you have? This will give us 10.
21.5.
21.5. Here is 21.5%. Then for Pascal, 6 plus the beta of Pascal is what? 0.65. 0.65 multiplied by 10. What do you get? Okay. 10 multiplied by
12.5.
12.5. 12.5%. For Binta, 6 plus the risk of Binta, which is 1.26. 1.26 into risk premium of 10. So that would be 18.6. 18.6%. Okay. Then for Yetunde, 6 plus the risk of Yetunde is 1.14. 1.14 into 10. So what do you get?
17.4.
17.4%. Now that we have computed the required return, we can then proceed to calculate our alpha. The first one is 21.5%. Here is 21.5. The second one is 12.5, right?
Yes.
And then for Binta,
18.6.
18.6, then 17.4. 18.6, 17.4. So you know that alpha is equal to, alpha is equal to, not theta. alpha is equal to ER minus RS. Therefore, 21 minus 21.5. What do you get?
Minus 0.5.
Minus 0.5. And I told you, once your alpha is negative, it means it is overvalued. In the question, did the examiner mention overvalue or undervalue? Let's go and check. Investing, so we are not told. Whether examiner did not mention either overvalue, undervalue, overprice, underprice, so we are not told. So you are at liberty to use anyone. Of course, it's the same thing, but at times it's good to be consistent with the requirements. So here is overvalue. This means that the shares in Tomiwa PLC is overvalued. Then 12.5 minus 20.5 is 0. This means the shares in Pascal is properly priced, properly valued, since we are using value. So properly valued. Let me extend that. Okay. Then 18 minus 18.6, that will be minus 0.6, overvalued. Then the last one, 18.5 minus 17.4, that's 1, is it 1.1?
1.1.
So this means the shares in Yetunde is undervalued. Shares in Yetunde is undervalued. So examiner is asking you to recommend, giving your reasons, whether the composition of Sumola Funds PLC short-term investment portfolio should be changed. Okay? So we need to remember, like I told you, you have to interpret your results, and that's what the examiner is asking you to recommend. I wouldn't say recommendation. Number 1, you notice that the shares in Tomiwa and then Binta PLC are overvalued, right? So I will say the shares in Tomiwa PLC and Binta PLC are overvalued. So because they are overvalued, what are you supposed to do? Therefore, the shares should be sold. The shares should be sold. That's that. That's our recommendation. Number 2, when you look at our calculation also, the shares in Yetunde is undervalued by 1.1. So the shares in Yetunde PLC are undervalued. Hence, more of the shares should be bought. That's that. Then the third one, since the shares in Pascal, since the shares in Pascal's PLC are properly priced, are properly valued, then the shares should be kept. Okay, that's it. That's our recommendation. That's our recommendation. 10 marks. We pocket it. Then number C, You have to explain. Yes, Jacob, talk to me.
Okay, so it's just an observation I made, right? So if you check the alpha values, like the summation of everything gives 0, right? So can we also add that their portfolios were properly priced since the summation of everything will give 0?
No, no need for that. All right?
All right.
It's just by coincidence. All right? It's just by coincidence that everything is 1. Minus 0.5, minus 0.6, which is 1.1, minus 1.1 plus 1.1 equal to 0. It's just by coincidence. So no need for that. All right? Okay. Yes. Move on. Then the number C part. Examiner is asking you to explain 3 factors that the financial manager should take into account when investing in marketable security. So you have to internalize and then personalize this requirement. Put yourself in a position of investor. Okay, put yourself in a position of investor that you want to invest in a short-term marketable security like a treasury bill or government bonds, right? So what are the factors you need to take into consideration? Number 1 factor is the initial investment. If you don't have the capital, you will not be able to make the investing decision, all right? You won't be able to commit you'll not be able to invest. Number 2, you need to take into consideration the tenure of the investment. How long? Is it for 3 months, 6 months, 1 year, or 180 days? All of this, you need to consider the tenure. Again, what about the inflation and taxation? Is inflation and taxation going to impact my investments? It's another factor. You also need to consider Forex, okay? You need to consider foreign exchange, whether Forex will impact your investments, because if the investment is volatile, then of course, your return may also be, your return and the value of your investments will also be impacted. So you also consider that. Not only that, you also consider liquidity. As a financial manager, you need to consider liquidity. The liquidity is the ability of the company to dispose of the investment when the need arises. Okay, when you need money, you can easily dispose it of. And that's why when you invest in short-term marketable security like treasury bill, maybe for 3 months, you've received your returns. Then you don't want to wait for the 3 months to lapse, or for the 6 months or 180 days to lapse. You can dispose it off. Okay, you can dispose it off, and then you get your money. All right, you get your money, and then that's essence of liquidity. So these are some of the factors you need to take into consideration when investing in short-term marketable security. Yes, Flora, talk to me.
Okay, sir. Good morning, sir. Sir,
Good
please, how
morning.
do you know when to compute for alpha in any question? I don't know.
Yes, if the key point is that for you to know whether you are to compute for alpha or not, if in the question you can see expected return. If you are given expected return, okay, you are given expected return, and then if examiner did not even ask you to compute for alpha, but once you can see expected return, then you also see the information that will enable you to calculate cappings. Then you need nobody to tell you that you are supposed to calculate for alpha, because it is possible in the question examiner may not ask you to compute, may not tell you to compute alpha. It may just be asked to recommend or advise. So if in the question you can see expected return, then you see information to calculate your capping, capital Z pricing model. Then you need nobody to tell you you have to calculate the alpha value. Okay, you have to calculate alpha value. All right. So let's have one more illustration. Let's have one more illustration. Let me stop sharing this. Please mute. This number 9 illustration is similar to the one we just solved, only that you are not given the expected return. In this case, examiner has given to you dividend yield. Yield is the same thing as return. Capital gain yield. Then all you need to do is to just add up the yield on dividend and the yield on capital gain to get your expected return. Then you now go and calculate required return, follow the same route. So this one is similar to what we just solved, but however, let's solve another one where you are going to, let's solve this number 7. Let's solve illustration number 7. Let me read. Capital asset pricing model is an equilibrium model of the trade-off between expected portfolio return and unavoidable risk. What are the basic assumptions on which this model is based? 6 marks. You can see 6 bonus marks. You already have it, so it's in your notes. Let's move on. Currently, the rate of return on the federal government bond redeemable at par in the year 2018 is 5%. So the rate of return on the government's bond redeemable at par in the year 2018 is 5%. That should be our risk-free rate of return, because risk-free rate of return is the return associated with government security. Therefore, my RF is there. The security of 4 companies, Akira PLC, Bombardier PLC, Courage PLC, and Define PLC, have expected return of 12%, 9.5%, 10.5%, and 13% respectively. The average, that is expected return. The average expected return on market portfolio is 10%. Okay, this is market return. So my RM is equal to 10% and subject to a 6% risk standard deviation. So the risk of the markets, DM is equal to 6%. Other relevant information relating to the 4 securities of the companies is as stated below. You are required to show which of the companies is or are overvalued. 9 marks. Yes, you can see Flora, based on the question you just asked, you can see in this particular requirement, examiner did not tell you to calculate alpha, but you are told to calculate or to show which of the company is or are overvalued, because examiner has mentioned overvalue. Say, for example, you have overvalued, undervalued, or properly valued, you should know that this is alpha. Something should tell you that the question relates to alpha calculation. All right, so let me stop sharing this and move to the working notes. Okay. Solution to illustration 7B. Akira, is it Akira PLC? Let me check again. Okay, we are not, there are so many comes off. We are less concerned with that. So let's move on. So examiner is asking you to show which of the company is or are overvalued. Okay. To do this, the first thing you need to do is to calculate. You go to the question, if you are not given beta value, the first thing you need to do is to calculate beta value of individual company. You calculate the risk of individual security. So without wasting time, calculating the risk of individual security, okay, which is beta. Therefore, I need to ask myself, which formula am I going to use to compute the beta? I've given you earlier today 5 different formulas. In this question, the examiner has given to us correlation coefficient and standard deviation. Therefore, my beta will be computed as correlation coefficient multiplied by standard deviation of security over standard deviation of the market. So for Akira, the risk of AHIRA, I will go to the question. What's the correlation coefficient of AHIRA? 0.975. 0.975 multiplied by standard deviation of AHIRA is 0.080. 0.080. Then divide by standard deviation of the markets. The standard deviation of the markets, according to the question, is 6%, because we are told that the average expected return on market portfolio is 10% subject to a 6% risk, that is standard deviation. So standard deviation of the market is 6%, 0.06. Give it to me. What do you get? Bombardier? Yes. What do you,
Michael,
1.30.
Hope is not paying you again.
1.30.
Eh?
1.30, 1.30.
So if you honestly, let me see. Oh, if you honestly, if you honestly.
Michael, please mute yourself.
Yeah, correct. Michael, come.
So, the expected return of Bombardier is 0.64. 0.640 multiplied by standard deviation of Bombardier 0.075. 0.075 divided by 0.06. What do you get?
0.8.
0.80. Okay. Then Courage. Correlation coefficient of Courage is 0.74. 0.740. Standard deviation of Courage is 0.09 divided by market risk. What do you have there?
1.11.
1.11. Then finally, for Divine, the correlation coefficient of Divine is 0.68. 0.680 multiplied by standard deviation of 1.5, 0.15 rather. 0.150 divided by 0.06. What do you have?
1.7.
1.7. Okay. Now that you have computed the risk of individual security, then you can proceed. Step 2 is to proceed to calculate the the required return of individual security. Required return. Number 2, required return. Calculating the required return. RS. So RS, risk-free rates, plus the beta of individual multiplied by risk premium. So for AHIRA, go back to the question, what's the risk-free rate of return? The risk-free rate of return, we are told that is 5%. Federal government bond redeemable at par in the year 2018 is 5%. So risk-free rate of return is 5 plus beta of AHIRA. For beta of AHIRA, we got 1.3. Here is 1.30 into market return. RM is 10. You are told that the average expected return on market portfolio is 10%. So market return is 10. Risk-free rate of return is 5. So give it to me. What do you get? So this will give us 5 multiplied by 1.3 plus 5 equal 11.5%. 11.5% is that. Then we have Bombardier equal to 5 plus the risk of Bombardier is 0.8, 0.8 into risk premium of 5 equal 5 multiplied by 0.8 plus 5 equal 9. Okay, this is 9%. Then for Courage, 5 plus the risk of Courage, which is 1.11 multiplied by 5. So 5 multiplied by 1.11 plus 5 equal 10.55. Then for Divine, 5 plus 1.70 into 5 equal 1.7 multiplied by, pardon?
13.5.
18.5.
13.
Oh, I tested you. Yeah, 13.5. Okay, then. Now that we have computed the required return, we can proceed to calculating our alpha. So, step 3. Step 3, calculating alpha value. Okay. To get the alpha value, create a column for the companies in the portfolio, expected return, required return, will give us alpha, then we can comment. You can see it's not difficult. The first one is Ahira, Bombardier, Courage, then Divine. Call the expected return for me.
12.
Sorry, guys, I had a little issue from my hands. Please, let's continue and wrap up the class. Sorry for the break in transmission. It was very unexpected. All right, so let's continue, please. Can you guys hear me? Speak up.
Yes, sir. Yes, sir.
Let me know you're still with
Yes,
me.
we can hear you, but the recording, sir.
Yeah, it's still on. It's recording. So let's move on. Let's continue. Yes. So we were trying to compute the alpha value, and I was asking you to provide me with the expected return as given in the question.
12 for Akira.
12 for Akira, 12% for Akira.
9.5. Yeah.
Hold on, here is 12. Then for Bombardier is what?
9.5.
9.5. Anchorage.
10.5.
10.5. Divine. 13. Okay, then. So our expected return we have computed for Akira is 11.5. Followed by 9 for Bombardier, then 10.55 for Courage, 13.5 for Divine. So let's find the difference. Remember, alpha is equal to expected return minus required return. So give it to me. The first one, 12 minus 11.5. This should give us 0.5.
0.5.
0.5.
0.5. The next one.
0.5.
The next one, 0.5.
0.05 negative.
0.05.
Minus 0.05.
Minus 0.5.
Minus 0.5. And we said that if your alpha value is positive, it means that the security is undervalued. In the question, did the examiner mention whether under or over? Yes, examiner said overvalued. So that means we are going to use value instead of price. Therefore, I would then say Akira is undervalued. Bombardier is also undervalued. Courage is overvalued because it's negative. Then Divine is also overvalued. So we need to advise. So examiner is asking you are required to show which of the company is overvalued. I would then say the securities or the shares in Akira PLC and Bombardier PLC are undervalued. Okay, even the examiner did not ask us to advise, but we have to do that. Are overvalued. Hence, are undervalued. Hence, more of the shares should be purchased. Then 2, the investments or the shares in Courage PLC and Divine PLC are overvalued. Therefore, the shares should be sold. That's it. That's the end of the question. That's the end of the question. It's as simple as that. You can see? So let's have one more illustration. Yes, this illustration number 6 is similar to the ones we solved. So because you are given standard deviation, you are given standard deviation, you are also given the, let me even say, okay, let's solve this one that you are not given expected return, so that in case you have similar question on the day of your exam, you will know what to do. Yes, illustration about 9, balloon PLC. Balloon PLC. I need somebody to read it. Read balloon PLC, please. Who is reading it? Balloon PLC.
Balloon PLC.
Okay, go ahead. Go ahead, read.
Balloon PLC has been enjoying a substantial net cash inflow. The funds have been invested in a small portfolio of short-term equity investments until they are needed to meet tax, dividend payments, and to finance further capital expenditure in several months' time. Details of the portfolio, which consists of shares in 4 Nigerian listed companies, are as follows.
Okay.
All figures are assumed correct. The yield on treasury bills is 11% a year, and the market return is 19% a year. Required A. Based on the data given, calculate the risk, that is beta, of Balloon's short-term investment portfolio relative to the market. B. Recommend, given your reasons, whether the composition of the company's short-term investment portfolio should be changed. Relevant calculations must be shown. C. Discuss the factors that a financial manager should consider when investing in marketable securities.
Thank you very much, Opeyemi. So when you look at this question of a balloon PLC, you will notice that it's slightly related. It's almost the same thing as the question we solved under similar funds, except that you are not given the expected return, because in similar funds, you have to recommend about the short-term investment portfolio. Number C, you also have to discuss the factors that the financial manager should consider when investing in marketable security. So which is the same thing. But in any case, to solve this question, you are told that based on the data given, calculate the risk, that is the beta of balloon short-term investment portfolio relative to the market. So you want to calculate the overall risk of the portfolio versus the risk of the market. So let me stop sharing this and move to that one so I can close the class quickly. Okay. Solution to illustration number 9. Okay. Examiner is asking you to calculate the overall beta. Okay, you have to calculate the overall beta. How do you calculate the overall beta based on the information given? In this question, the examiner has given you the number of shares. You have been given market price per share. You have been given the beta of individual security. Okay, what test can you ask for? This is very straightforward. So I would then say, of course, to calculate the overall beta, number A, calculating overall beta of the portfolio. Okay. So which method am I going to use? You're supposed to use weighted average method because you are given number of shares, you are given market price per share, you are also given the beta value of individual. So I will create a column for company, column for number of shares, market price per share, total market value, the beta of individual security, and the weights. All right. So we have company, what are the companies? Company Dashing PLC, Elegant PLC, Fantastic PLC, Gaudy PLC. So let's use letter GEFG. Company GEFG. Call the number of shares for me.
60,000.
60,000 shares. Next.
80,000.
Next.
100.
And then
125.
125,000 shares. So let's insert the market price per share. The market price per share is different from par value. So market price per share is 4 naira 29 kobo for D. 4.2. Okay, the next one is what?
2.92.
2.92. Next.
2.17.
2.17. Next.
3.14.
3.14. Thank you. Then let's insert the beta value as given in the question. Equity beta coefficient 1.16 for the first one.
1.28.
1.28. Next.
0.90.
0.90 and then
1.5.
1.5. Okay. 1.5. So that's it. Now let's compute the total market value. So 60,000 multiplied by 4.29, what do you get?
257,400.
257,400. 257,400 multiplied 1.16. What you get?
298,584.
298,584. Okay. 80,000 multiplied by 2.92.
233,600.
Okay, I didn't get that.
233,600.
233,
600.
600 multiplied by 1.28.
299,008.
299,008. Then this one will be 217,000 multiplied by 0.9.
195,300.
195,300. Then the last one, 125,000 multiplied by 3.14.
392,500.
392,500 multiplied by 1.5.
588,750.
588,750. So add up the total market value and the total weights.
Total market value 11,00500.
500. Okay.
Total weight 1381642.
1381642. Therefore, the overall beta will then be equal to the total weight over total market value. That's not it. Which is equal to 1,381,642 divided by 1,100,500. So what do you have? 1.26. 1.26. I would then say the overall or the risk of Balloon PLC investment portfolio of 1.26 is higher than the market's risk of 1. Okay, that means investment is riskier. The risk of the portfolio is riskier. The portfolio risk, since it is higher than the market's risk. So, yes, Debbie, you raised hand. Talk to me.
Yes, sir. I want to confirm something. When
Yes.
calculating the number of shares, it's not supposed to be like the shares divided by the par value, but we didn't do it in this case. We assume just 60,000 shares, 80,000 shares. Because if we're going to go like that, elegance supposed to be 80 divided by like 0.50. I don't know.
Debbie, you're on your own. No? You're on your own. Already, number of shares has been given to you in this question. You only do that. Number of shares, if number of shares is not given to you in the question, that's when you do that. So to get the number of shares, it is share capital divided by the par value. So in this particular question, number of shares has been given. So there's no need for you to go and be doing share capital over par. Not even given share capital. So why do you want to do that? Okay. So you only divide the share capital by the par value or by the nominal price if you are not given number of shares. So to get number of shares, it is share capital divided by the nominal value or par value. But in this question, examiner has given to us number of shares, so there's no need to do that. Just multiply number of shares by the market price per share. We are good. All right. Is it clear now? Debbie? Okay.
Yes, sir.
Yeah, right then. So let's continue. So examiner is asking, based on the data given, calculate the risks of balloon short-term investment portfolio relative to the market. We have done that. 4 marks. We have pocketed 4 marks. Then number B part, you have to recommend, giving your reason, whether the composition of the short-term investment portfolio should be changed. Okay. Therefore, what am I supposed to do? First thing first, I need to compute the required return. I go to the question if I'm given expected return. Expected return is not given to us, but we have information to compute that. So without wasting more time, let's go and calculate the expected return, required return. Okay. This page for our advice. Then let's do our working for here. Okay, working number 1. We need to calculate the expected return since it is not given to us. Expected return, ER. So according to the question, of course, create a column for company, G, E, F, ZDF, E, F, and G. Okay, and G. Then examiner has given us, according to the question, we are not given expected return, but you are given the yield. Yield is the same thing as return. You are given dividend yield. So let's say dividend yield. You are also given capital gain. Capital gain. Then now give me expected return. Let me do it this way because of space. Dividend yield. Capital gain yield. So G, E, F, G. So give me the dividend yield.
6.10 for D.
6.10.
3.40.
3.4.
5.7.
5.7.
3.3.
3.30. And capital gain yield is what?
13.4.
13.4.
20.6.
20.6.
11.8.
Okay, the last one.
19.7.
19.7. So to get the total yield, then you now add the two together. That's what?
The first one, 19.5.
19.5%.
The second one, 24.0.
24.0. Okay.
The third one, 17.5.
17.5. And the last
The
one?
last one, 23.0.
23.0. So now that we have the expected return, we need to compute the required return. So working number 2. So we cannot get the required return. We are going to first calculate the expected, okay. Since examiner has already given us the standard deviation of individual security, so let's calculate the required return. Required return, RS. Okay, so RS equal to the risk-free rate of beta into market return minus risk-free rate of return. So for D, go back to the question, what's the risk-free rate? We are told that the yield on treasury bill is 11%. The yield on treasury bill is the risk-free rate of return, 11%, plus the beta of security D. Beta of security D is 1.16. 1.16 into market risk premium. Go back to the question. The risk rate, the market return is 19%. Here is 19 minus 11. Give it to me. What do you have there?
20.3.
20.3. I didn't get that.
20.3%.
Okay, 0.3%. Then for E, 11 plus the risk of E of elegant is 1.28. 1.28 multiplied by market risk premium, which is 8. Difference between 19 and 11 is 8. So give it to me.
21.2%.
21.2%. Then for F, 11 plus the risk of F is 0.9. 0.9 into market risk premium. What do you get? Yep.
18.2.
18.2%. The last one is G. 11 plus the risk of G is 1.5 multiplied by risk premium of 8. Give it to me.
23%.
23%. Now, we have just computed the required return and the expected return. So we can then go back there and put in the numbers. Okay. So I will come here, number B, calculating alpha. Okay. So company expected return in percentage, required return in percentage, alpha also in percentage. Then we can insert comments. Company D, E, F, and G. The expected return we computed is 19.5, then 24. 19.5, 24.0. Then the last two,
17.5
yes, 17.5.
and
So
23.
17.5 and then 23.0. The required return we computed for D,
20.3.
20.3,
21.2.
21.2,
18.2.
18.2,
23.0.
23.0. Therefore, we need to get our alpha, 19.5 minus 20.3. What you get?
Minus 0.8.
Minus 0.8. The next one,
2.8.
2.8. Next,
Minus 0.7.
0.7. And the last one is 0.
0.
So comments, this is overvalue or overpriced.
Undervalued.
This one is underpriced.
Underpriced.
Then overpriced.
Overpriced.
Then properly priced.
Properly priced.
Okay, let me write that. All right. Okay. So, examiner is asking you to recommend. So, we have done this previously. Number one, the shares in Dashing PLC and what is F? F is Fantastic PLC and Fantastic PLC are overpriced. Therefore, they should be sold. Number two, since the shares in Elegant PLC are underpriced, more of the shares should be bought. And then three, the shares in Gaudi PLC are properly priced. Hence, they should be kept. Hence, the company should hold on to the shares. That is, they should be kept. So that's that. In the C requirements, you have to discuss the factors that the financial manager should consider? I've already said that earlier today. Yes, Okwe, talk to me.
Please, can you scroll down to the required return?
Required return. This?
Yes. Please, where did we get the risk premium? 90 minus 11, 888.
Pardon?
Where did we get, okay, for D now, 19 minus 11, 888.
Right now. The difference between 19 minus 11, what will it give to you?
Okay. 888.
So, I don't need to be
Okay, so where did
repeating.
we get it, please? I'm
Get
not
what?
seeing it.
The question.
Get what? Okay.
RM minus RF.
In the question, market
Oluwa.
return is 19%. Risk-free rate of return is 11%. Difference is 8.
Okay, thank you. I've seen it.
Or are you saying you can't find it in the question?
I've seen it now. Thank you.
All right then. So that's end of the question, and this may bring to an end the class. Let me see if there's any question that we want to try. Let me stop sharing this. Get out. Let me see. So you can go and try other examples, other illustrations in the material. You see the solutions in there are more solutions in the golden book. You see that in this requirement number 3, sorry, in this illustration number 3, you have to calculate total present value. Already you know how to calculate present value. So discount factor multiplied by the cash flow will give you the present value. Then number B, you have to determine the overall beta. How do you calculate the overall beta? So since you have the present value is the same thing as market value. Therefore, calculate total weights. Once you get the total weights, then the overall beta factor of the company Y, then it become the total weights divided by total market value. So you are now asked again to explain how portfolio diversification reduce the risk experienced by any investor. That is, you have to explain how to reduce portfolio risk through diversification. All of this are very straightforward. Even though we have not done portfolio theory for the online students, again, it's pretty straightforward. You can get it in the golden book. All right, so there's no big question here that you cannot solve. So these are, you can go and try this illustration number 4. It's just NPV. Examiner wants you to calculate NPV, but first thing first, before you can get your NPV, you have to use capital asset pricing model and the Gordon growth. So what this simply means is that you need to go and calculate cost of equity using capital asset pricing model, then cost of equity using dividend valuation model. So once you have that ready, then you can then go ahead and compute your NPV. Okay, you go ahead and compute your NPV. So that's that. So that will be that from me to you. Let me know if you have any question for me before we close the class. Any question? Okay. So if there's no further question, that's the end of today's class. I will see you next time by the grace of God. For the online students, we are meeting later tonight. All right. Thank you guys for your time and understanding. Bye-bye.